One of the best ways to make money is to buy stocks in companies that pay out regular dividends. Due to the fact that you're investing for regular, steady payouts from older, more well-known businesses. Some people might think dividend investing is boring. However, regular returns are never boring. In the past, dividend investing was a popular way for investors to make money. Even though dividends aren't as high as they were in the past, there are still many benefits to dividend investing plans. But before we continue with the rest of this video, please remember to click the subscribe and thumbs up buttons as well as the bell notification icon. This way, you'll be the first to know whenever we release new exciting videos. Also, we'd love to hear from you, so please leave a comment in the comment section below. Make sure you watch the entire video as we will mention a free way for you to win a $20 Amazon gift card. Okay, now let's continue with our video. What is dividend income? When a shareholder company produces money, it has three alternatives. It can spend money on research and development. It can either save or pay dividends to its stockholders. Savings account earn interests. Dividends return it to you. A 5% dividend yield means that for every $100 invested in the company, you will receive $5 in dividends per year. With monthly dividends, you can safely increase your emergency fund. Dividend income can be a long-term asset for any saver. The income for long-term investments can aid retirees. Consider both favorable and unfavorable considerations when investing for dividend income. Firms may change dividends at any moment. You can also expand your wealth by investing in smaller, less established companies that are more inclined to reinvest their earnings. Dividend investing in long-term portfolios. If you own stocks or index funds, you may already be participating in dividend investing. For example, about 77% of Standard & Poor's or S&P 500 stocks pay dividends, which is a good thing. There's a 1.70% dividend yield on the S&P 500, which doesn't sound like much, but it's a lot higher than most average savings account rates or even treasury bond yields. Still, from a historical point of view, it's very low. During most of the 20th century, the annual dividend yield of the S&P 500 was between 3% and 5%, but this changed over time. When companies aren't giving out a lot of cash, dividend yields have been going down, which means investors are getting less money back. This is for several reasons. Low savings account and bond yields make dividend stocks easy to find. If the savings rate was 3%, a 1.79% dividend would not be tempting. There is little need to raise dividends now, given the low interest rate environment. Thus, tech businesses have grown in importance over time. So this is why overall tech companies are more likely to invest in new projects than pay dividends. How dividend reinvestment boosts your returns. Despite these developments, dividends remain an important aspect of investing that may help you gain more money. Reinvesting dividends to acquire more stock in your portfolio helps it grow quicker. Simply put, reinvesting dividends offers you the right to receive additional dividends in the future, potentially increasing your investment returns. Consider buying an S&P 500 index fund in February 2000 and holding it until October 2020. A 4.2% annual return on stocks would have given you a cumulative return of 136%. Isn't it great if you maintained all dividends and reinvested them in fund over the same time? Your average yearly return would have been 6.2%, and your cumulative return would have been 247.2%. Dividend reinvestment would have almost doubled your gains. This is how it worked. With some freely available online calculators, you can discover more dramatic effects. What would happen if you invested $10,000 in an S&P 500 index fund in February 1990? Price increases alone will get you to around $91,300 now. A lot more than that. You would have almost doubled the amount, or you'll have $180,000. Tax benefits of dividend investing. Dividend investors may be able to profit from important tax benefits. But the Internal Revenue Service doesn't treat all dividends the same. Dividends are taxed differently depending on whether they are qualified or unqualified. Qualified dividends are taxed at the lower long-term capital gains rate, while unqualified dividends are taxed like other income. Most U.S. companies provide eligible dividends, which are taxable. That implies dividends are taxed at the long-term capital gains rate, if held for more than 60 days. Ordinary dividends are taxed as regular income. They come from real estate investment trusts and master limited partnerships, or MLPs. Money market funds and other cash-like assets pay the same dividends as other types of money. Earned dividends in tax-favored retirement plans like IRAs and 401ks are not taxed until withdrawn and paid. How to evaluate dividend stocks? One way to figure out which stocks pay the best dividends is to look at their dividend yield. However, the highest dividend yield alone can be deceiving. Consider a stock that pays $5 annual dividends and recently traded at $100 per share. Its business suffered, and its stock price dropped to $50, yet it still pays a $5 annual dividend. In a short time, the dividend yield would have doubled from 5% to 10%. In this case, a rising dividend yield suggests stress, not health. If a company's stock price drops, the board may need to reconsider the dividend. Choosing dividend-paying stocks takes a lot of trust. Is this corporation stable enough to keep paying the promised dividends? And maybe increasing them? Look for dividend aristocrat stocks, which have increased dividends over time. Stocks in real estate and utilities may also pay higher dividends. To get the dividend payout ratio, subtract the stock price volatility from the equation. If a company earns $2 per share and pays $1 quarterly dividend, its payout ratio is 50%. Low payout ratios should suggest more sustainable dividends or dividend increases. The company may need to lower its dividend if its payout ratio is over 100%. In a mature market, an increasing payout ratio may reflect a company's health and stability. How you can pursue dividend investing. To gain money through dividend investment, you have three options. Aim for high dividend yields. This is a typical dividend investment technique. Invest in slow-growing, mature companies with lots of cash flow and big payouts. These investments make sense if you need immediate income. Remember that profits alone are not enough. The company's stock prices may not grow as fast as companies with smaller dividend yields. Choose high dividend growth. Long-term investors can buy stocks in companies that are rapidly expanding but now paying lower than average dividends. Short-term income is lower, but as a company grows and develops, the dividend yield should improve. Early entry allows investors to buy more shares and receive more dividends. In the long run, the lower cost on yield is better. Pursue dividend capture. This method of capturing dividends is more active and hands-on. In order to get a dividend, you don't have to keep the stock for a year or a quarter. Rather, you acquire them just before the dividend is paid. In order to buy more stocks, you must first sell your existing ones. To receive a quarterly or annual dividend payment, you must own the shares 2 weeks prior to the payment date. Then you must select when to sell after the dividend is received. Complications and danger arise because share values are variable and may fall after dividend payment. This kind of reduction in price can quickly wipe out your dividend earnings and more. The tax rate on short-term capital gains is higher than on long-term capital gains. Risks of dividend investing. dividend investing, like any other approach, carries risk. The main danger is that dividends are never guaranteed. Companies may and do cancel dividends. For example, Wells Fargo, Dix's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus, and Rolls-Royce have all fallen during the pandemic. But there are some issues. Anyone who is way too focused on dividends is likely to miss out on important sectors and company classes that might help diversify their portfolio. For example, young IT businesses seldom pay dividends. Lack of diversity usually increases instability. Dividend-only investors risk missing out on high-value growth in industries that don't pay dividends or pay them at low rates. We hope you enjoyed this video. Again, don't forget to subscribe, like, click the notification bell, and leave us a comment below. We'd love to hear from you, and we'll be doing a random name drawing of the first unique 100 commenters of this video. The lucky winner will get a $20 Amazon gift card. So get involved and don't be shy!